Uncertainty and volatility are the key features of the markets as we enter March and leave summer behind us. So what's driving the uncertainty, and what can we be confident about in the near term? New US Fed Reserve Chair Jerome Powell has put a dampener on the stock market's attempt to fully recover last month's sharp losses. Ironically, with a fairly upbeat Congress testimony on the US economy, which has the market again reminding itself that US interest rates are set to rise as much as 1% this year, the first hike likely on March the 21st. The stock market has been grappling with the strength of the economy, soon to be accelerated by US tax cuts, against the near certainty of higher US interest rates, as well as the unknown impact of trade tariffs for steel and aluminium. So having retraced around 2/3 of the early February fall, there are renewed worries about asset prices in this late cycle, potentially overheated market. We're 9 years on now from the absolute lows in the depths of the GFC in March 2009, so beware the Ides of March. But again, this is all against the backdrop of a strong US economy and upgrades to growth around the world. We'll see if stock markets can recapture January highs to avoid a deeper sell-off. This volatility has also spread to currency markets, where the US dollar, which had been weakening throughout 2017, is now getting some support after Powell's comments, and has the Aussie dollar on the back foot now that US bond yields are actually above ours. The last time we saw this was back in 2001, when the Aussie dollar was closer to US 50 cents. We suggest avoiding getting too negative on the Australian dollar just yet, while it is above the key 75-cent support level. But similarly to the stock market, the inability to break higher has some calling for a sharp fall. Other factors impacting our exchange rate include commodity prices, especially iron ore, which is remaining fairly firm based on demand for steel from China since the New Year holidays, although the latest Chinese manufacturing survey results were a fraction below par. Locally, we saw private sector CapEx data out yesterday, which didn't help the Aussie dollar either, being down 0.2% for the December quarter, although the spending intentions for the new financial year were higher. So, amid this uncertainty, what can we have some confidence about? Firstly, the RBA are very likely to keep rates at these record lows throughout autumn and winter, despite our expectations of ongoing strength in local jobs and business confidence. And in contrast, the US will be lifting interest rates, and global growth is trending higher. Until our interest rates need to rise, when inflation and wages growth starts to pick up, this should support a fairly stable housing market and slow but steady growth locally, even while market volatility is on the rise. We'll get the next read on our official GDP growth on March the 7th. And that's the latest update from Bendigo Bank.